Welcome to The Explainer. Today, we are taking on a really fascinating challenge. We're going to force a highly speculative, clinical-stage biotech company right through the rigid, historically conservative valuation lenses of some truly legendary investors. We're looking at Rapport Therapeutics. They're pushing the absolute boundaries of neuroscience, and we want to see exactly what happens when that kind of clinical promise collides with old-school, hard-nosed financial metrics. Honestly, it's the ultimate stress test. Let's get right into it. So, here is the analytical gauntlet we're running today. First, a quick company snapshot. Second, we'll view them through the Warren Buffett lens. Third, the Peter Lynch lens. Fourth, the Benjamin Graham lens. Fifth, we'll dive into DCF valuation and alternate models. And finally, number 6, our synthesis and recommendation. Okay, Section 1, Company Snapshot.
Now, look at the tension right out of the gate here. Rappaport's current stock price is sitting at exactly $41.46 a share. But when you peek at their first quarter 2026 financials, they actually posted a net loss of almost $20 million. That results in an earnings per share, or EPS, of negative 42 cents. So right away, you have to ask yourself, how on earth do we justify a $41 valuation on a company that's currently pulling in negative earnings?
Well, to answer that, we really have to look at the science. Their lead asset is called RAP-219. It's designed to selectively target receptors in discrete regions of the brain where seizures actually originate, completely bypassing the hindbrain where traditional drugs tend to cause nasty side effects. And the recent Phase 2a follow-up data for focal onset seizures, it's incredible. They showed a 22-day half-life for the drug and a massive 90% median reduction in clinical seizures during weeks 9 to 12. Because of those results, they're stepping on the gas and launching 2 Phase 3 trials in the second quarter of 2026. On top of that, they've got a rock-solid cash runway that funds them all the way into the second half of 2029.
And you know, this recent move perfectly illustrates their strategic maneuvering. Early in 2026, Rapport secured a cool $20 million non-refundable upfront payment from Tenacia Biotechnology for rights in Greater China. This is huge because it doesn't just give them early external validation of their pipeline, it actually injects crucial, non-dilutive capital straight onto their balance sheet.
Moving on to Section 2, the Warren Buffett lens.
So this is our ultimate value check, right? Buffett demands economic moats, predictable earnings, high return on equity, and manageable debt. And honestly, we've got a total fish out of water situation here. Rapport completely fails Buffett's strict financial criteria. His whole framework relies heavily on owner earnings, basically the free cash flow that an owner could just pocket. But since Rapport is pre-revenue and burning nearly $33 million a quarter on R&D, their owner earnings are severely negative. Their return on equity, also negative. From a purely quantitative standpoint, it's a hard pass from Buffett.
But hold on, Buffett also cares deeply about honest, competent management and a sustainable economic moat. Listen to CEO Abraham Ceesay talk about focusing on non-dilutive capital and maintaining a disciplined, capital-efficient strategy. That kind of talk would definitely earn a nod of respect from the Oracle of Omaha. Plus, Rappaport's RAP technology platform, which selectively targets that TARPG8 protein, represents a legitimate, patent-protected moat. But to actually pull the trigger and buy, Buffett demands a massive margin of safety. He'd probably only be interested if the market cap absolutely collapsed down closer to their actual cash value, which is around $10 a share. At $41, he's walking away. Value purists should probably look elsewhere.
All right, Section 3, the Peter Lynch lens.
Lynch famously loves to categorize companies into different buckets to figure out their underlying story. Now, he usually relies heavily on the PEG ratio, price to earnings divided by growth. But for Rappaport, their historical earnings growth is literally 0, so calculating a PE ratio is mathematically impossible here. Instead, Lynch would focus purely on the narrative. If RAP-219 gets FDA approval, Rappaport instantly becomes a classic fast grower. But as things stand right now, today, Lynch would definitely categorize this as an asset play.
And here is exactly why. It's all about their fortress-like balance sheet. Rapport ended the first quarter of 2026 with $476.8 million in cash equivalents, and short-term investments. That's almost $500 million. Now compare that to their total liabilities, which sit at a measly $26 million. That financial condition is just phenomenal for a biotech company. Because institutional ownership is driving the narrative here, and their asset base is just so incredibly strong compared to what they owe, Peter Lynch would likely view this as a very attractive speculative buy, betting purely on that balance sheet's ability to fund the ultimate fast grower story.
Which brings us to Section 4, the Benjamin Graham lens.
Okay, brace yourselves, because this is where the gauntlet gets absolutely brutal for a clinical stage biotech. Graham is the undisputed godfather of value investing, and he takes zero prisoners. Let's walk through his defensive investor checklist. Adequate size? Pass. At a $41 stock price and over 47 million shares, the market cap is approaching $2 billion. Strong financial condition? Pass again. Their current assets completely dwarf their current liabilities. But then, bam, we hit a brick wall. Earnings stability? Fail, they're losing money. Dividend record? Fail. Moderate price to earnings? Fail. The PE's undefined.
And to really nail down intrinsic value, Graham uses a very specific formula. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. Let's do that math together. Rappaport's total stockholders' equity is $471.5 million. You divide that by their 47.2 million shares outstanding, and you get a book value per share of exactly $9.98.
So let's plug those numbers in. We take 22.5, multiply it by the EPS, which remember is negative 42 cents, and multiply that by the 9.98 book value. The final result inside that square root, it's a negative number. And actually, mathematically speaking, the square root of a negative number is undefined. In Graham's eyes, this intrinsic value is effectively zero because there's absolutely no current earning power to anchor the valuation. There is zero margin of safety here. Graham wouldn't just pass, he'd issue a hard sell.
All right, let's pivot to Section 5, DCF Valuation and Alternate Models.
Since our historical value investors clearly struggle to price the future potential of a drug, we need to turn to modern quantitative forecasting to try and bridge that gap. To build a discounted cash flow model, a DCF for a pre-revenue biotech, we have to make some heavy assumptions. First off, we're assuming commercialization of RAP-219 starts around 2029, which is exactly when their current cash runway ends. Second, we forecast a really steep ramp in free cash flow, but we offset that by their continued heavy R&D spending. And finally, to account for the huge inherent risks of clinical trials and FDA approval, we have to apply a high discount rate, or WACC, somewhere between 12 and 15%.
Take a look at the sensitivity table because it shows just how fragile these assumptions are. If we use an overly optimistic 10% discount rate, the fair value soars way past the current $41 stock price. If we swing the other way and apply a really punitive 15% WACC, the value drops down to around $38 to $43. But if we settle somewhere in the middle, a realistic 12% WACC with a very conservative 2% terminal growth rate, our base case fair value lands at $51.30 per share. Suddenly, at $41, the stock actually looks undervalued. See what I mean? It all comes down to your personal risk tolerance.
Let's apply a couple of alternate models just to double-check this. First, a reverse DCF. If we work backward and reverse engineer the current $41 price tag, the math tells us the market is already pricing in near-perfect clinical execution and hundreds of millions in peak sales by the early 2030s. Second, let's look at the analyst consensus model. Polling 12 analysts from S&P Global, the consensus is a strong buy with an average price target of $56.64. That represents over 36% upside. It's pretty obvious the modern models see a massive potential here that Graham's strict formula completely missed. And finally, Section 6, Synthesis and Recommendation.
Let's bring all these distinct frameworks together for our final verdict. Here is the ultimate scorecard. As we saw, traditional backward-looking value models reject Rapport entirely. Graham's formula literally breaks and yields zero, and Buffett would demand a massive discount, closer to that $10 cash value, just to feel safe. But the forward-looking and growth-oriented frameworks, they paint a totally different picture. Peter Lynch sees a fascinating asset play funded by nearly $500 million in cash. Our own DCF model points to a fair value of around $51, and Wall Street analysts are targeting over $56 based on that incredible 90% seizure reduction data. So blending all of this impartially, Rapport represents a highly speculative but incredibly well-funded buy for growth investors willing to stomach binary clinical risk. But for traditional value purists, it's an absolute avoid.
Which leaves us with one final lingering question. Is the groundbreaking clinical promise of Rapport's precision neuroscience worth ignoring the ultimate value investing stress test? It really highlights a fascinating reality in today's market. Sometimes, to capture the future of medicine, you have to leave the formulas of the past behind. Thank you so much for joining this explainer, and as always, keep questioning the metrics.